This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make any investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast.
My guest on the show today is Ben Kohn, President and CEO of PLBY Group, Inc. It's a publicly traded company. The symbol is PLBY on NASDAQ. PLBY Group, Inc. is a global pleasure and leisure company connecting consumers with products, content, and experiences that help them lead more fulfilling lives. PLBY Group's flagship consumer brand, Playboy, is one of the most recognizable brands in the world, with products and content available in approximately 180 countries. We all know the brand. We all know who Playboy is, the history, the bunny ears, the magazine. It's an iconic brand. Those don't just grow on trees, nor have the cultural awareness like a Playboy has had for 70 plus years now. However, following its botched go public strategy in 2021, management has been working hard, picking up the pieces to turn things around. That's what I wanted to chat with CEO Ben Kohn about, who's very gracious and quite candid as we discussed the corporate history of Playboy, how they are focused on returning customers to Playboy's roots, licensing deals, specifically the Byborg deal, managing cultural risks, and their 3 to 5 year vision for the company. With that, please enjoy my conversation with Ben Kohn, President and CEO of PLBY Group, Inc. Ben, thank you for joining me today. How are you doing?
I'm doing great. Thanks for having me.
Absolutely. It's great to have you. So PLBY Group, this is all part of the reemergence in a sense of Playboy Group and whatnot, or PLBY Group. So I appreciate you jumping on here today. And for folks that are listening in, they're also going to be presenting at our upcoming investor conference in Vegas on April 22 through 24, 2025. PlanetMicrocapShowcase.com to register to meet with them and see them in Vegas. So with that, Ben, obviously a lot of people, this is probably the most well-known brand we've had on the show in the many years of doing this. Been around for 70 plus years. But for people who may be under a rock or somewhere else, what would you say is that one line that best describes the PLBY Group?
It's Playboy, right? It's that most iconic rabbit head that is recognized everywhere in the world, right? We have pretty much 100% unaided awareness. Every country I've ever traveled to, you see that rabbit head in some form. And so that's what represents PLBY Group. We have another business in Honey Burdette, but that core asset, the way I think about it is that's my Dallas Cowboy asset, right? And so we are a sports team for lack of a better term, because it's a brand that on a global basis, you could try to go spend billions and billions of dollars to replicate and would be impossible to replicate today.
Absolutely. All right. So now I'm going to ask this next question. It's the same one I ask everybody on here, but I'm going to ask it a little differently because clearly everybody knows the history and the launch, with Hugh Hefner, all that stuff.
1953.
Yeah. So I'd love to, from a corporate perspective, from the beginning, the evolution, and how, catch us up to where we're currently at today, how the structure is currently, the Hefner family still involved. Love to get the full kind of picture there.
So we are a publicly traded company. We went public through a SPAC in 2021. Obviously, have suffered through that, as well as some things that we've done. But what's so great about 2025 is where we are on a macro basis. I think we're returning the company to its roots. First and foremost, our primary customer is a male, is a men. Our secondary customer is a female that love men. And we're going back to what made Playboy famous, which is that magazine. So we brought back the magazine in February of this year. Lori Harvey on the cover, Nikki Glaser in the magazine, phenomenal Playmate of the Year. And our plan moving forward is to continue to publish that magazine, not this year in 25, but as we get into 26 on a quarterly basis is our plan, bringing back that iconic Playmate franchise, 12 Playmates a year, plus the Playmate of the Year. There's no better brand ambassador than the Playmate. And then developing new revenue streams around it. But the magazine is not a business into itself today. It's our brand Bible that we leave behind. And so we're thinking about a really thick coffee table book that people are proud to display with phenomenal journalism coupled with phenomenal pictures. I mean, you can, whether you read it for the picture, you read it for the articles, or you opened it for the pictures, it doesn't really matter to us. We're going to make sure that we have great quality on both. And then, the other revenue streams that we've built off the back of it. This is one of the most iconic brands in the world. And the reason I always equate it to a sports team is you look at the Dallas Cowboys and you say, what are the Cowboys worth? Or what are the New York Giants worth versus what do they produce? There's a pretty producing cash flow. It's a pretty dislocated asset. But again, this is an asset that you couldn't replicate on a global basis today, right? You would spend billions and billions of dollars to try to replicate it. Now, our goal moving forward is to stay asset light. We're in the process of downsizing the company and going back to focusing on the brand, which is our core asset, not on operating, which we proved that we weren't great at. But we have the ability to leverage this phenomenal brand, work with the right celebrities and influencers, journalists, et cetera, and then leverage that, partnering with great operators around the world to exploit that brand through their products and services that they're great at operating on.
Absolutely.
And so, but the biggest thing that we're returning to is what made Playboy famous, right? Which is the magazine, and what does that brand represent? It elicits that emotional reaction within the consumer. When I think about the brand, I think about a few keywords, right? First, it's fun. I think people today, after everything we've been through the last 4 or 5 years, want to have fun. The second is Playboy's provocative, it's sexy, and it's aspirational, right? It's i.e. James Bond. And so that's what our focus is moving forward. We have very clear, words and a mission statement to describe the brand, and that's what we're going to continue to execute on moving forward.
Absolutely. So, real quick, I was going to, I had a couple other things I wanted to go down, but since you brought up the magazine, and that is, the return to the main focus there, just published for the first time in 5 years, right? In February 2025, or it was 5, 6 years?
Something like that. Yeah. It's 4 years or 5 years, but somewhere it was too long.
Well, no, because it's interesting because we bring that up because I've had a number of conversations with folks, because we publish a magazine here, Planet MicroCap, obviously not on the same level as Playboy by any means, but we've had these fun conversations about the return, and we've gone full digital for a while, and we kind of been talking a lot about all right, well, is the glossy, beautifully well-made magazine back? Is that kind of making a comeback? Because there's, especially at least in the finance space, there's been others that have now been publishing, just a magazine because people love, I'm a book, you can see me, I'm surrounded by books. So I mean, yeah, right. So I mean, just from your perspective, do you feel that there is that trend, kind of a return to the glossy holding of the magazine versus getting away from just the digital publication?
Yeah, look, I think the magazine is something tangible that you can leave behind, that you can touch. And look, I don't think there's a magazine business today per se. The economics behind building a subscription business are really hard.
Brutal.
This is a brand also that is always been, when Hefster first started the brand, they didn't take advertising, right? It was built on subscription. And I think we have to be really careful, and I think we've made missteps along the way, but we've learned from that, right? And I always view it's okay to make mistakes, just don't make the same mistake twice. And so we have to be careful that we're not trying to build a magazine business, because by definition, I'm trying to build a subscription business, which is really hard, and then I have to have advertising to support it. Well, if I have advertising, then I get to the CPM basis, right, which is how advertisers buy advertising. That doesn't mean I'm staying true to what Playboy is. And so Playboy is a brand, right? First and foremost, we are this iconic American brand. And so my view on the magazine is, if I have advertising or I have sponsorship, that's great, but I'm not going to do anything to sacrifice the brand at the expense of trying to get more distribution. We're going to focus on this as a brand Bible. And so, but I do think it allows us to work with celebrities and influencers, that there's a real carrot at the end of their stick. There's the reward of being in Playboy, right? And if you go back through our 72 years, some of the most iconic figures in the world have been in Playboy, right? It started with Marilyn Monroe and the Pam Andersons, but then you also have, Steve Jobs and MLK and Malcolm X, et cetera, with the Playboy interview, the famous Jimmy Carter interview. And so there's very few brands, I can't really think of any, that have had that sort of the Marilyn Monroe, the Pam Anderson, but then, former presidents in the same book. And so for us, it's important, but we also have to recognize what it is. And then the question is, okay, if you're producing this book, which is a marketing expense at the end of the day, we're not a brand that goes and spends tens of millions of dollars taking a billboard in Times Square, or putting celebrities on really expensive Super Bowl ads, right? The way we market this brand is through that editorial content. And so we also have to say, okay, well, if that's a brand expense, what are the revenue streams that we could build off of it?
Right. My next question.
And that's what we're focused on right now. So, I use the Playmates as a great example, right? And going back to what I just said about the Dallas Cowboys, and now I'm going to talk about their cheerleaders, but there's a great show on Netflix, right? Which is basically Making the Squad, right? And so you look at that and you go, okay, well, could I imagine a show around becoming the next Playmate? It doesn't have to be a Netflix show. It could be a YouTube show. Yes, I could. Could I see podcasts where, it's the Playboy Advisor, which was a column that's been in the magazine, or a franchise that's been in the magazine historically, giving relationship and sex advice? Sure. Well, could I integrate my Playmates into that in a way that is a video podcast, similar to what we're doing today? 100%. That could be really interesting, right? Especially with the number of followers that our Playmates have. And if we do it the right way, they become Playboy followers as well, right? And so those are all new revenue streams that we haven't explored historically, that we can explore moving forward. You look at shows like Dancing with the Stars and The Voice, and the fan voting that takes place in that, right? Well, a quasi version of an OnlyFans, if we said, hey, we're going to have a celebrity panel of judges picking the next Playmates, right? Playboy editors, but maybe this is a panel of judges, coupled with fan voting, that could be a really interesting business. And so those are the things that we're working on moving forward, where we leverage that franchise asset, the magazine, that brand Bible, but we're thinking outside, the two covers, the back and the front cover, of how do we monetize this in other ways, and also recognizing that, I could go produce as many copies as I want of the magazine, but how many people actually go read it and consume content that way today, right? And so you have books behind you, I have some books behind you. We also have to recognize that that is not the primary way that consumers consume content today, right? Consumers consume content through audio and video, and we have to think about audio and video first, with the magazine almost being the byproduct of that.
Absolutely. All right, we have a lot to dig in even from there. So, it seems that you're hitting on a lot of things that, are ways in which you can leverage the brand, in the near term, the future, whatnot. What are some of the things that are being done right now in order to obviously generate some revenue, keep everything afloat, that kind of thing?
Yeah. So look, we have a great licensing business. We're fortunate with that. We had gotten into operating. We realized how hard it was, and we sort of hit a perfect storm, coming into COVID.
Not just operating a media brand. Let's call it
even worse. I was trying to operate after we went public, a consumer product brand, which is even harder than operating a media brand to some extent. Okay. And so we looked at it and we said, okay, well, when we went public, where were consumers spending money, right? And consumers were spending billions of dollars a year buying Playboy clothing. They wanted to wear it on their front or on their back, okay? And so we said, okay, well, if they're spending all this money buying consumer products with the Playboy logo on it, why don't we just do that ourselves? So instead of making, 5 cents on the dollar in a typical, or 7 cents on the dollar in a typical licensing deal, let's capture 100 cents on the dollar, and we'll be able to realize the same EBITDA, if not more. And the reality situation is, it was a hell of a lot harder than we thought. We also ran into a few issues, which was, at the time, we were generating about $40 million of revenue coming out of China. This is just before COVID. That basically went to zero in a year. That had like an 80% margin on it. So really hard to cut your way out of that one. And at the same time, we were levered. We had debt on the business. And so our cost of our borrowing doubled as well, right? So it wasn't just like a 32 million, which was the 40 million at 80% impact, right? My cost of borrowing went up by $10 million a year, right? So it's $42 million. There wasn't that much margin in the business to begin with, okay? And on top of that, we took on all these public company costs. So my cost infrastructure ballooned as well. So call it $50 million I'm now in the hole versus when I was private. That's really hard to come by. In 24, we finally got past that. and we're back to having a really profitable licensing business. About 86% of that revenue is guaranteed in the form of minimum guarantees, and then we have substantial upside above it. So what we've done is we've basically reduced our corporate overhead. We've gotten into the business to a place today where we will be free cash flow positive moving forward, even with our debt, based on sort of a really reduced corporate overhead coupled with this licensing business. And then in addition, we own this brand we bought in 21 called Honey Birdette, which is an Australian lingerie brand. We've gotten that business last year to start producing cash for us. It will produce more cash this year than it did last year. And at the right time, I think what we have to ask ourselves is, are we the right owner of that business? I have my personal opinion, which is at the right time, we're not the right owner of it. I don't want to sell it from a position of weakness like we were forced to do last year. We actually put the business up for sale. We never actually officially launched the process, because at the same time, we started working on this buy board deal, which has really transformed the company financially. And so we pulled that process. We focused on continuing to operate it. But at the right time, especially given that we still have leverage on the business and given that we have $400 million in tax shelter, we shouldn't have leverage on the business because the leverage doesn't really provide us much except a cash expense. I think that we should at the right time, not today, but at the right time, we should find another partner for Honey Birdette. And that alone, if we do it right and continue to improve the business, should be able to delever the company fully. And then you have a really good operating business because you have a ton of guaranteed, no cost, basically licensing revenue with low corporate overhead. And that should be a business that produces a ton of free cash flow. And then you have to decide what to do with that cash flow.
Absolutely. So, you hit on a couple of things that I wanted to also ask you about, but, real quick, I have to ask you, why did you guys go public? I'm just curious.
My guess is I'm probably not the only CEO that's asked that of themselves in the past.
Which, listen, there's many benefits of being public. We're not trying to say being public versus private, one is better than the other. There's many pros of being public. It's just it's just curious based on, where you were at in the business at the time. And then obviously what happened post back, I'm sure that you got that all the time. Hey, why did you guys do that?
Yeah. And look, I think I'll give you the answer because obviously you have investors, okay? And then, investors always are looking for, what is the exit opportunity at some point, although our investors haven't sold a share and neither have I. And so, but I think, look, we thought through a couple things. First is the ability to raise capital. And we ended up raising capital when the stock was way up on sort of the NFT news at the time. Obviously now much harder to raise capital. The second is a recruiting tool for employees because you can offer them other things beyond just cash as a public company. And the third is, my background was 25 years in private equity. We had a phenomenal track record back in the day. And so the ability was to also say, could you use other things beyond just cash, like stock, to buy other businesses, right? Obviously, we bought some businesses. It did not work out. A lot of it was because of timing. Some of it was self-inflicted. So not going to make that mistake again, but it does give the capital structure additional flexibility than a private company. It does come with a whole host of other issues. And I think one of the issues we realized, especially going public through a SPAC, which at the time there was a lot of hype around SPACs, is that being public is different. It's hard. It's really hard, right? And so, just from an accounting and compliance perspective, and I think one of the issues I think a lot of SPACs have had is when you go public through a SPAC, it's not like a traditional way. And I had done that when I was a banker way back in the day in a previous life. But, companies work on that for 2 years before they go public. SPAC's a merger, right? I was used to that from my private equity days. All of a sudden, the next day you're public and you're like, holy shit, for lack of a better term. I have to now report on a quarterly basis, but I not have to just report internally to my shareholders. I have to report, under GAAP and publicly acceptable accounting standards on a public basis with real liability. We ended up spending, God sums of money after we went public, trying to play catch up, which is really hard. But, we are public today. I think, I think there's definitely, in my personal opinion, a big dislocation between the value of our assets and the value of the stock. But you know what? I'm not a stock picker. I have a job to focus on operating the business, and over time, if we execute, the market will hopefully reward us for that. And I think there's advantages to it long term as well, right? If we can get to the other side of this, which I think we've already passed that inflection point. Now the question is, how much free cash flow can we produce? And there's a lot of growth opportunities out there. Then being public might be really good on the backside of this again, which is it gives you the ability to do other things with the business. You can buy back stock, you can pay a dividend out. There's a whole host of other things that you can do on the backside of it. And even some companies out there view that as a positive, that, you could become an acquisition candidate, or you could be acquisitive. What I don't want to do ever again, is acquire businesses that are really tough to operate. My private equity days were always great, which is you could show up for a board meeting, but you didn't have to deal with the day-to-day stuff. And so I think, again, as I said, it's okay to make mistakes. You just don't want to make the same mistake twice. Don't want to go back to doing what we did, which is you have to run these businesses on a daily basis, because that's really hard. And I have a full appreciation for people that do it and do it well.
No, I appreciate that full background. And yeah, like I said, look, it's just interesting sometimes when you kind of do when you just look back in hindsight and think about all these things, what happened, what didn't happen, and then also now, all right, we're here. How can we leverage this to our advantage? And it seems like you guys have definitely thought that through for sure. Want to ask about the Byborg deal. You mentioned that earlier in a previous answer. Tell us more about that.
Yeah, so I actually met those guys, I want to say 18 months ago, something like that. And Byborg is a phenomenal operator. What I would say is the adult content space. One of the best out there, really good processes and technology in place. And so called them up end of last summer, last fall. And we started a conversation we had the prior year, and wanted to see, based on the businesses we were operating, which was Playboy TV, the Playboy Plus, which is our legacy gallery website. Two businesses we weren't really investing in because financially we couldn't. And then the Playboy Club, which was our creator platform. Was there something that might be synergistic for both parties? And it turned out to be a great deal, great people over there. They ended up licensing out those three businesses from us. And in addition, have the rights to do like AI girlfriends and other things like that. It really transformed the company. So in addition to a $300 million minimum guarantee licensing deal, so $20 million a year for 15 years, plus we get 25% of the profits above that moving forward. So we've maintained, a really good upside. And if they execute, we should see multiples of what we're making today, but they have to execute. But they have all the chops to do it, right? They're a really well-oiled machine from an operating perspective. They have resources that we did not have. The businesses are tougher than when we started, even the creator platform, with the age gating that's required, at least in the United States, by 21 states today. And so they have all of that technology wherewithal to be able to do it. They have the processes to be able to do it. And then their core website, which is Live Jasmine, has 70 million daily customers coming to it. And so can they take some of that traffic and start to, move it to Playboy and other places? If I was a betting man, us doing it ourselves versus them doing it, it's night and day. And so I'm excited to see what they can do with it. They also made a approximately $22 million investment in the company last year, and we're currently out to shareholders, and we just announced yesterday that we're going to be extending the voting period because we did not get to a quorum, to have them invest another $25 million into the company, which is subject to a shareholder vote, because NASDAQ has something called the NASDAQ 20% rule, which means that a company can't issue in a private offering more than 19.9% of its securities to one party without basically a change of control issue. And so you have to get shareholder approval. And so we're out getting to shareholder approval. We have a proxy solicitor that's out there trying to get the vote in to approve that deal. It was a deal that the board agreed to and recommended to its shareholders. And so look, I'm excited. I was just in Budapest at their management retreat 2 or 3 weeks ago. I can't remember now. And it's a great group of people and really a great visionary in Mr. Gatian, who is the owner and the founder of the company, and excited to see what they can do with the Playboy brand in their respective areas.
Very interesting. I mean, does this kind of deal, does this open, I mean, it's you guys are pretty married, right, at this point in many respects. Do you have the flexibility to do a similar type of deal with another Byborg type company, or is that not really of interest? Because, if you were to do this, it's like, all right, we're going to do this Byborg and call it a day.
So the way our licensing business works in general is by geography and by product category. And so I can't go do another deal to do a creator platform, for example, because Byborg has those rights, and we want to make sure that we invest as a brand with our partners as well, meaning, how can we support our partners to grow their businesses? So we would never do that, right? They're a partner in that category. Could I go do another Byborg type of deal, which is really, can I do a big licensing deal with someone for categories? The answer is sure, subject to what are my contractual obligations today in certain categories. Our typical licensing deal is somewhere between like 1 and 5 years. So as things roll off, you could do bigger deals. In fact, that's part of our strategy, right? Today, I have about 104 licensing partners. 65 of them produce less than $500,000 or $600,000 in total revenue to us. Would I love to take those 65 and whittle that down to a smaller number? If that opportunity existed, sure, it makes it that I don't need as much infrastructure to manage. If I took 65 and said I can get down to 4 partners instead of 65, that's a lot less infrastructure I need. But more importantly, it gives me more brand control, right? Because I have one partner that I can work with much more deeply than trying to work with 65 partners, and making sure that things are aligned with everything else we're doing as a company. There's some categories out there that we're thinking about where, over time, again, we want to be respectful of all of the contractual obligations we have and won't violate those. But over time, I could see us, having fewer, bigger partners, and, at the end of the day, better credit quality partners as well. And I think that's something that we should strive to, and that only allows us, puts us on better financial footing, even though we're on good financial footing today. But more importantly, I think from a brand perspective, it allows you to bring the brand together on a global basis so that you don't have small partners with certain categories and territories that just add confusion to the overall consumer view of the brand in those markets.
So what's the difference between like the brand Playboy TV, for instance, which Byborg has the licensing rights to, compared to, you're talking about doing kind of like a America's best, the next Playmate type show, sure, right? Or the podcast. Like, help me just separate that out so that I can understand that better.
Sure. So Playboy TV is it's a premium subscription television product, largely through linear television, and focused on the not safe for work or adult space. Right, doing a mainstream Playboy TV show that would not have nudity as part of it, because you couldn't do that on YouTube or Netflix or other places. That is not part of that. That's part of the rights we have from a brand perspective. It doesn't mean that you couldn't air it on Playboy TV as well. But Playboy TV itself, the business model behind that is, the majority of the revenue is linear television, meaning they don't own the relationship with the customer. You go through DirecTV or Comcast or whoever, and Comcast upsells that as a premium subscription channel, i.e. an HBO. And that the reason that most of the people are subscribing for that channel is for some sort of adult content on that channel.
Very good. All right, real quick on Honey Burdette. Where are we at? Where are we at with Honey Burdette? How'd the business do recently? And like you said, long term, is it something you want to own? Probably not, but just love to hear what the vision is, at least in the near term, as it relates to that.
Yeah, so I think it's continuing to execute on the operational improvements we put into the business over the past 12 months. So our timing couldn't have been worse when we bought Honey Burdette. It was August of 21, and I think we might have closed like August 13th. I can't remember the exact date. It's too old, right? But I think like literally 5 or 6 days or a week after we closed, Australia decided to go on lockdown again. Not as bad as China, but they locked down for 3 months. And when you're a fast-growing business, especially during the COVID era, and you're buying a lot more inventory, because you start to see everyone was at home, and does that continue? How much was COVID? How much was just growth in the businesses? A lot of e-commerce businesses have the same issue. You get stuck with a lot of inventory. You have to work through that inventory, right? And there's 2 ways to work through that inventory. We either go to Bondi Beach and we have an unbelievable bonfire, or you decide to sell it, and we needed to sell it because we needed the cash as a company, and we just bought this asset. And unfortunately, that leads to higher sales but lower margins, and it also has a brand impact that you have to then catch up on. And so last year, we decided to significantly cut that back, the number of days we were on sale. So by definition, revenues can fall, regardless of whether the same number of customers are buying product. It's just that you're not doing promotional activities. And so therefore, you're selling more full price items. Now, we saw that in gross margin. So in the fourth quarter of 24, our gross margin expanded from 51% to 60%. We saw full price items actually increase in sales. We saw same store sales growth year over year. So all very positive trends. And I would expect that, based on the people we've hired, we brought back the former CEO of the company when we had first bought it, who had left, but now has come back. Some of the new designs that they put in place, the product is resonating with the consumer. It's still significantly underpenetrated. If you look at the best performing stores, right? It was a business that was founded in Australia, was largely an Australian business. The stores we've opened in the United States are the top performing stores within the company. Our stores in Florida, Miami, Boca, Tampa, et cetera, they kill it, right? Our Vegas store kills it. It's still significantly underpenetrated in the US and Europe. I wish we had more capital, and this is why I say, are we the right owner for it? You should invest in more brick and mortar stores. Because they're free marketing, right? You put up a store, people are like, oh, what is Honey Burdette? They go in and they realize it's a great product. And so what's really interesting about that Honey Burdette is the repeat customer rate. It's huge. And also actually it's on first time purchases in the US, it's like 50% men, 50% women, which is really interesting. So men are buying it for their significant other. It's a great brand. It's changed a lot, obviously, in the consumer landscape. Australia's been hit harder than the United States because of the mortgage market down there being much more of a floating rate mortgage market than the United States is. But I'm encouraged by where we sit. I think we'll be up this year over last year, which is great, and especially as we focus on margin and sort of brand health. And then the question is, how big can we go? And as our balance sheet has improved, over time, if we continue to own it, we can invest, and we'll have the flexibility to invest more money into growing it, or we could partner with someone that could do that as well. But it's definitely a product that resonates with consumers, and it's a business that is now producing free cash flow for us, which is great. That's a huge help, and I'm excited by what comes. And at the end of the day, I think we've said this in multiple different ways, but we're focused on improving that cash flow, increasing the enterprise value, and that is one more arrow in my quiver that gives me financial flexibility moving forward as we look to continue to delever the business.
Very good. Well, and apologies for jumping around, but I one more quick question on the buy board deal. I mean, is the vision for this relationship? I mean, I see that they're operators of like Live Jasmine, some of these other online.
Yeah, check out their new product, Jasmine.ai as well, which they've just launched sort of as a soft launch, which is like an AI girlfriend thing. It's really great technology. I got to see it for the first time when I was in Budapest 2.5 weeks ago.
Oh, interesting. So, I mean, is the idea to create like a kind of an OnlyFans type platform using the Playboy brand? Like is that really the main kind of idea there?
No. So, I mean, I think they view Playboy as one of the premium brands in the world. The conversations we've had with them and Mr. Gatian, we were lucky enough to have him join our board. Mm-hmm. So, for that, because I think he brings a really good perspective to the board, but his main focus is brand, right? They actually want me to invest more in the brand than they can invest because I as a public company have to make sure I stay free cash flow positive. But over time, hopefully we can continue to invest more in the brand, because what I can tell you about making brand investments, and we've done this before, I can't give you an immediate ROI on that, but I can tell you that when we've done this in the past, the impact to the brand a year, 2 year, 3 years down later is huge. So we should be investing in the brand. In our budget this year, we are reinvesting in the brand. That's why we're relaunching the magazine. But they're focused on brand. I think there's a lot of low-hanging fruit and things that they can improve on our existing products. But to answer your question on OnlyFans, we actually had built our own OnlyFans product called the Playboy Club, which was our creator platform. I think we did a good job on it. It's, building technology is hard. You don't get it right every single time. It takes time. It's testing and iterating and testing and iterating. I think just based on how long they've been operating in this space, they're going to be able to make a number of changes that will significantly increase both the revenue and the profitability of the platform they've taken over. So that deal, the licensing part of that deal went into effect January 1st. So they own the P&L of those businesses. In the first 6 months of this year, we'll still have some transition costs related to that. But the revenue of it, and I think they're in the process of transitioning all 3 of those businesses over to them, making the improvements they need to make to those businesses as they transition them over, and increasing the revenue and the profitability of those businesses.
Very good. No, I appreciate you clearing that up for me. And listen, I'm not, I ask a good, a good question, and then not so good questions every once in a while. But anyways, we've gone through a lot with Playboy. Obviously, you guys have been on the road. I mean, we're recording this on Friday, March 21st, 2025. You're just at Raw, a number of investor meetings there. Even after, everybody knows the brand, they got to handle all the businesses, they understand buy board and whatnot. What do investors maybe still get, or potential investors still get confused about when thinking about PLBY Group as it exists now and the future prospects?
Yeah. And actually the Roth conference, it's the first time we've actually gone out and talked to investors in 2 years, because for the last couple of years, we've been sort of putting our finger in every new leak that has sprung up. And then finally we've gotten through this, and I think, right now we're on solid financial footing. And so now it's time to go out and retell the story. I think where I see a lot of investors sort of get confused in the beginning, or sort of have some questions, is trying to pull up numbers on FactSet, or look at the historical financials and bridge from the historical financials to where we are today. There's been so much transformation in the last 9 months of this company. And there's so much noise as you go through those transitions. So, right, I mean, even when you look at our fourth quarter that we just reported on a few weeks ago from 2024, you go back and you go, well, sales decline. Well, sales decline, why, right? There are a couple of reasons. One is Honey Birdette, you're coming off of a highly promotional year. So if you cut the number of days down, you're going to decrease sales. Two is, specifically, we had to terminate our former partners in China because they violated our contracts. They didn't pay us. Okay. So there's an accounting acceleration in Q4 2023 that did not happen. It wasn't a cash acceleration. It was an accounting acceleration tied to 606 and the termination of the contract that you didn't have the following year. And so I think it's bridging investors and basically saying, hey, look, as much as it's hard to do because it's intuitively not what they do, forget about what you've seen in the past. This is what the business looks like moving forward. What complicates that, I think, is we have been more reluctant to give guidance. We tried to give some guidance or projections for this year, but we disappointed investors. We fell short of our goals. I take it personally. I'm a highly competitive person, and you have to go back and rebuild your reputation. And the last thing you want to do is go out and say you're going to do X, and you do X minus whatever percent. And so, you go back to actually the question you asked a little while ago about being public. This is one of the hard things about being public, is you put out numbers, based on a year, and you put out projections about what you think is going to happen. That's just not the way business works, right? And so, business is moving every single day, right? And so things happen, deals that you're projecting might get done in Q2, get done in Q3 or Q4 or whatever. Numbers move. I've always had this debate internally. Do we ever even want to give projections again or guidance? Or are you better off just saying, let the numbers speak for themselves and call it a day? And, personally, I'm in the latter camp, because the former camp, you're always putting a target on your back.
For sure. Well, I actually agree. I agree with you very much on that. Obviously everyone loves to see guidance, helps, no question. But, I've been more of a fan, especially when you're a growth story, or just growth company, microcap space. It actually hits on my last question that I always ask everyone on here, and it's why I ask it, is what is your vision for the company in 3 to 5 years? That makes more sense to me to understand where you're going and that part of it, versus the near term. You kind of lock yourself in, and then you start having to do things that maybe you probably would otherwise not do, but you're like, oh shoot, I just put out this near term guidance, and now I gotta think short term. Like, dang it.
Well, and this is also the problem in the United States, right? Which is companies report quarterly, and there's a lot of work that goes into reporting on a quarterly basis.
Course,
I wish we reported semi-annually. Like, here's the half year update, and this is what the year looks like.
Australia does that, right?
In places, Europe
does. Okay, yeah.
And it's actually much more how business flows, right? This SEC quarterly reporting that investors require. I understand why they require it, but it's not really how businesses work, right? And so look, my vision is continue to build the Playboy brand, make the brand extremely desirable, and aspirational in the consumer's mind. And financially, I want to continue to grow our business in an asset-light model and produce as much free cash flow as I possibly can produce while delevering the company.
Absolutely. All right. I'm going to come back to that question again.
And okay. Sorry.
You're good. We were kind of going there, but I want to ask one more kind of devil's advocate type question. I ask it everybody on here. Also in your opinion, what would you say are some of the company's downside risks? I just right off that, obviously execution, we put that aside. That is obvious. We understand that. But when I think about PLBY Group and everything that you're doing, there's also kind of in a weird way, a cultural risk in some senses, right? You think back to 2018 or 2017 with the rise of, what was it? My gosh. Me Too movement. Yep. So I'm just curious, how you've thought about that in terms of, moving forward, that's, it's not as prevalent as it was in 2017, but it's still very much around and important and things to think about. So I'm just curious from your perspective, how are you positioning PLBY for any type of cultural trends that could have potentially negative effect on the brand for no reason other than what Playboy has traditionally been associated with?
Sure. So look, we always say this brand's 72 years young. You could call it 72 years old. Think about brands that are 70 plus years old. There's very few of them. Okay. You can think about Coca-Cola. You can think about Disney. You can think of a few others. This brand has weathered over the years a lot of different things through society. We went through the Me Too era. I think, the team we had did a really good job. We're in a different era today, and it doesn't mean that in 3.5 years from today or 3 years and 9 months, something doesn't change from a societal perspective. But I think if you look at where we are today, I think there is a sense of normalcy returning to society. It doesn't mean that a lot of the things that have happened over the past few years aren't good for society overall. But the pendulum always swings, and I think most people, and you saw this in the elections, right, with how Trump won, most people view the pendulum had swung too far in one direction, and now we're going to go back and find whatever that new equilibrium or center point is. It might be slightly different than it was before, and that's for the betterment of society as society moves forward. Moving forward, I think, look, you have to change as society changes, but I think the biggest thing is we have to stay true to who we are as a company. I made the mistake at one point. I think we went a little bit too woke. It doesn't mean that some of the woke stuff is good, because that's part of the history of this company, fighting for these First Amendment, and libertarian rights. But I've also said, and people have said, well, good and bad about it, but sometimes you go woke, you go broke. I think at times we might have gone a little bit too far, and we might have alienated what I would say is our core customer. And in retrospect, at the time it was right. In retrospect, you look back and you go, okay, wait a minute, would I have made the same decision again? I think that I'm always willing to admit when I'm wrong. And at times I think we've been wrong, but the question is not whether I was wrong or right, it's how do I learn from that mistake? And I think that's the biggest thing. And so I think that there are times we've made some mistakes. We're lucky enough that we have a strong enough brand that can recover from that. And you look at it today and you go, the brand is really relevant. And you look at the celebrities and the influencers that want to work with us, and that tells you everything, right? And the people buying our product. And so I think moving forward, though, my big thing, for whether it's me or my successor at some point, is staying true to what Playboy is, right? And when I think about those 4 key words, right? Fun, sexy, aspirational, provocative, that speaks to the core of Playboy. And I think we have to make sure that we maintain that moving forward, even though society at times will change. That's okay, right? We can change with it, but we have to stay true to what our core DNA is. And I think that's the one thing when I look back at times, I'll take full responsibility for it. We moved a little bit too far away at times from that core DNA. That's okay. We have a really strong brand that's been around for 70 years, and has had the opportunity to rebound from that. And we see it even with this magazine. I was just on the phone with our magazine partner yesterday, actually. Historically, you would say, oh, 20% sell-through is great, 30% is awesome. I just found out yesterday our sell-through rate at Barnes & Noble, which was our exclusive brick and mortar partner for the magazine, or retail partner for the magazine, the sell-through rate went up to 50%. So that's interesting, right? They sold out on e-com altogether, and was talking about the next magazine and what do we do differently. And the person that runs e-com for A360 said, I want double the number of issues. I wish I had double the number of issues because I just could have sold them. And so that to me is really interesting. And now the question is, okay, what else can we do as a brand moving forward, like the Playmate competition? How do we bring more marketing assets? Because we didn't bring a lot of marketing assets this time, because when we did this magazine, we were in financial duress last year. Now we're not. How do we put the full weight of the company behind it? Not that we're going to make a lot of money in the magazine, but it's all the ancillary revenue streams that come off of that, and doing that in the right capital light way.
Absolutely. So my final question then for you to hear, and by the way, I appreciate you addressing that and talking that through, because I mean, Playboy is in such a unique position, as a company, as a brand, from a cultural perspective, where it's gone through the setting culture in many different ways, and it especially through the 70s, 80s, 90s, 2000s, and then kind of having to adjust to how culture has been moving just so quickly, in the last 10, 15 years. So
yeah, I think people
super fascinating. Like, just to see how you manage that.
Yeah, and I think that's where old people always get, like, they're always like, oh, well, nudity's free on the internet, right? Well, yeah, but that's not Playboy, right? That's one facet of how the brand expresses itself, as this freedom of expression. That's not Playboy and why people buy Playboy products and services, right? Playboy is truly this lifestyle brand, and that's the other big thing is, moving forward, some of the disconnect that some investors have. But go ahead. So final question.
Final question then for you also here is twofold. One is, in your opinion, and where would you really like to see this brand in 3 to 5, or where would you like to see PLBY Group specifically, not necessarily the brand? where you want to see PLBY Group in 3 to 5 years, what's your vision for that? What would you say are the inflection points that'll get you there? And how do you continue to attract folks to want to work with the brand, talent in terms of, journalists and talent and whatnot. So I'd love to hear your thoughts on all that.
Yeah. So I think, first.
Got another hour, I guess? No, I'm just kidding. Sorry.
I got 8 minutes, but I can stay a little longer. So, okay. So, a couple different questions. So I think I said, where do I want to see Playboy? Look, I look at brands out there like Red Bull, and I could say, like, could you see Playboy, where you see Red Bull in a lot of areas?
Playboy Formula One team? No, just kidding.
I think I would want to go to Formula.
That'd be pretty sweet.
That's a great story of like taking that Netflix show and completely bringing in a brand new audience. Those guys, the guys at Liberty, have done such a great job with that. But could I see like where you see Red Bull in a lot of places? Could you see Playboy? 100%. But look, I think, as I said, I think forget about PLBY Group, because I think actually, honestly, we should change the name to Playboy. I think it actually confuses people. I hate the first line of every press release, like PLBY Group, the owner of one of the largest brands in the world, Playboy. Let's just call ourselves Playboy, right? This is where we've overcomplicated ourselves. So what I would love to have is a thriving asset-light business partnered with great operators around the world, producing a ton of free cash flow, debt-free, and then we can decide what we want to do with that money, right? There's a lot of different options to continue to increase shareholder value over time. So that's what I would love to see happen with Playboy. I think, going back to the other part of the question on the cultural relevance, that comes down to, working with the right people, having the right people internally, from an editorial perspective, from a magazine perspective, with the right contacts, and making sure that we stay true to who Playboy is. I think if we continue to stay true to who Playboy is, this iconic, freedom of expression, libertarian, sexy as hell, provocative, i.e. counterculture. I remember had a great partner in this woman, Rachel Weber, who was my former chief brand officer. And the story was, she was unsure. She had been the same at National Geographic. And when she joined us, and she works for Paris Hilton now, but when she joined us, she was debating whether or not to join Playboy. And she went into one of the rooms we have at the offices and put on, it wasn't a Miri, but it was one of our partners' jackets, and you put it on and you go, well, what's the feeling? And it's like, it's badass, right? It's this counterculture. And I think that is really the emotional reaction that Playboy elicits, whether it's good or bad in consumers, right? Because I can give you a lot of consumers that are like, oh, Playboy's been horrible for society overall, right? I don't believe that, but I can give you a lot more consumers that will say Playboy's been good for society overall. And so, but it's that emotional connection that you can't buy, right? It's felt. And that's why I think, moving forward, we have the ability to work with the right celebrities, with the right influencers, with the right voices in the world, that will continue to push society forward in the right way. And we have a platform that they can leverage and we can leverage to continue to grow the business.
And that's a great place to end it. Phenomenal. Really, really great. Thank you for answering all my questions and really great answers. That was really informative. So with that, Ben, where can our audience go and find more information on PLBY Group for now? And
I guess
Playboy.
go to playboy.com, go to plbygroup.com. That's our investor website. And look forward to talking again at some point. So I appreciate it.
Absolutely. Ben, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. And I will see you in Vegas.
Sounds great. Thank you very much.
Thank you.
This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make any investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast.